Yes, sir. So yeah, Well Health. This actually comes in from a client, Gord. I've actually got a phone call with him tomorrow, so you'll be able to watch this while we're on the phone, probably as well. Um, so yeah, Well Health Technologies, WELL on the TSX. Currently trading at a price of $6.15, $1.5 billion market cap. They don't pay a dividend. And the company provides omni-channel healthcare services, including primary care and allied health clinic operations. The company also operates an electronic medical records platform, billing and revenue cycle management solutions, and cybersecurity protection and patient data privacy solutions. And as of the last quarter, 94% of total revenue was from patient services revenue, while 6% was from software as a service. So, just a little history to catch viewers up to speed on Well. We have covered the stock on the podcast several times, including back in 2021 when it traded at $7.50 per share. Since then, we have seen the stock pull back to about $2.56 in late 2025, but it had a strong 2023, which we then covered it again on the podcast in February of 2024. And at that time, I basically concluded that revenue growth was quite strong given its aggressive cadence of acquisitions funded through debt and equity. And, I said if the company can begin to achieve consistent accounting and adjusted profitability and use internally generated cash flow to bolster growth and pay down debt, there could potentially be an inflection point in the business, but I said that is yet to be determined. Now, today the stock trades just above $6, and let's look at what's been driving the stock higher and if that inflection point is starting to transpire. So, just a quick couple of recent updates here. On February 19th, Well provided updates on two acquisitions completed by its subsidiary WellStar, including MicroQuest and Bluebird IT, with WellStar CEO commenting, as WellStar scales its operations and prepares to be spun out of Well as a separate public company that will be majority owned and controlled by Well, we are delighted to announce the recent addition of MicroQuest, a leading EMR solution provider, and 51% ownership of Bluebird IT, which supports over 700 clinics and hospitals across Canada. And this is really on the heels of its news release on December 12th of 2024, where they rebranded Well Provider Solutions as WellStar, subsequently indicating that WellStar closed on a $50.4 million equity placement, which is expected to fund the company's pre-spin-out growth objectives, with WellStar's pro forma revenue expected to be over $70 million in 2025, with EBITDA margins of approximately 20%. And the pre-financing enterprise value for WellStar is approximately $285 million, with Well expecting to spin out WellStar before the end of 2025 and will provide investors exposure to a pure play investment in healthcare technology software as a solution. Now, a few more updates here. On December 2nd, 2024, Well announced that it completed the acquisition of the Canadian clinical assets from Jack Nathan Medical Corp, including a network of 13 owned and operated clinics, which generated revenue of over $9 million in the past 12 months, and about 59 licensee clinics that generate approximately $2.2 million in high margin revenue. And as a part of the deal, Well has also entered various agreements with Walmart Canada that provide a framework to support the potential expansion of Well's clinical network within Walmart Canada's footprint of over 400 locations over time. And I've actually covered Jack Nathan on the podcast before. It trades under the ticker symbol JNH on the TSX Venture, but it has really struggled to generate any operating profit over the years. It's always reported an operating loss, which likely makes sense why it is selling its Canadian clinics. And on November 7th, the company raised its annual revenue guidance, which I will go into further later in my presentation here. So Well's revenue growth has been very strong, driven by acquisitions and organic growth. The most recent financial results were for Q3 of 2024, ended September 30th of 2024. Revenue was up to $252 million, an increase of 23%. Patient services revenue was about 94% of total revenue, while SaaS and technology services was 6% of total revenue in the quarter. And the growth was from, management says, 23% organic growth, but there was about 4% growth from acquisitions, but this was offset by some divestments as well. And the company's accounting earnings were negative in the quarter, primarily due to a change in the fair value of investments, which were a loss of $77 million, which, if we adjust out, the company produced a gain of about $1.3 million, or about half a cent. This compares to a loss of about 3 cents for the same period last year. So just keep in mind here going forward, all of the adjusted EPS figures I highlight are my own calculations. I'm not using the company's reported adjusted EPS. Now, I'll also note that the strong net income reported in Q2 2024 should also be adjusted to the downside, meaning the 43-cent per share is inflated, as again, there was a fair value adjustment, but this time it was a gain of about $116 million, which if we adjust out, they actually only did about $649,000 in net income, or about 0.003 cents per share in the quarter. In Q1, again, same thing. There was some changes here in fair value and a disposal of assets, which they actually lost about 2 cents per share. And the same can be said for Q4 of 2023, where they lost about 3 cents per share rather than a gain of 12 cents per share. So I just wanted to go over that just to make sure that we're kind of like looking at the same numbers here. Now, adjusted EBITDA in the quarter was up about 16% to $32.7 million. And looking at the balance sheet as of September 30th, 2024, Well had $66 million in cash, and debt and leases were $396 million, providing a net debt and lease position of approximately $330 million and a net debt to EBITDA multiple of about 2.7 times, which compares to a year ago of net debt of about $359 million and a net debt to EBITDA multiple of 3.3 times. So debt, is coming down, but it's still very elevated. And quickly looking at the valuations, the company has a negative trailing adjusted earnings, which I had calculated there. So we don't have a multiple there. Its enterprise value to EBITDA multiple is approximately 15 times and trades at about 12 times trailing cash flow. Looking at the company's fiscal year 2024 guidance, annual revenue is projected to be $985 to $995 million, which is 27% growth over 2023. Adjusted EBITDA is projected to be in the upper half of its $125 to $130 million range, which would be 12% growth over 2023. And adjusted free cash flow is expected to be $55 million for the year. So if we use these forward guidance figures, we're looking at a price to free cash flow multiple of about 27 times and a forward enterprise value to EBITDA multiple of about 14 times. And I keep referencing this every time I cover the Well on the podcast. But again, the reason for the company's ability to continue to make acquisitions on top of its hefty debt load is that the company continues to issue shares quite aggressively, as shown in the chart in my slideshow, with the company now up to 250 million shares outstanding. And I must remind our listeners that an acquisition growth strategy funded through issuing shares can be successful, but it is a much harder path to growing cash flow per share or earnings per share than simply recycling excess cash flow into acquisitions. So to finally conclude here, Well continues to show great revenue growth over the past few years, with revenue of just $32.8 million in 2019, now guiding to over $980 million for fiscal year 2024. The company's astonishing growth has been driven by acquisitions funded through share issuances and debt. It's good to see that the company is producing cash flow, which will help the company pay down its debt, which, like I said, is on the high side currently, with a net debt to EBITDA multiple of about 2.7 times. And hopefully this cash flow begins to reduce its reliance on issuing shares. The company is planning to spin off Wellstar in late 2025, which is expected to be worth a pre-financing enterprise value of about $285 million, and produces revenue of $70 million and EBITDA margins of above 20%. And Well will remain the majority owner of Wellstar. The forward valuation multiples of 27 times free cash flow and about 14 times adjusted EBITDA are not cheap, in my opinion, especially when we consider the balance sheet. But all in all, the company still has work to further progress into consistent accounting earnings, more significant free cash flow, reduce its debt load, and reduce its cadence of issuing shares. I love that the company is guiding towards positive free cash flow in the year, but I'm not confident enough to say that the business is at an inflection point, especially if they want to maintain their aggressive cadence of acquisitions. I think that the direction of the business is trending positively, and there may be some speculative upside, despite the stock being pricey on a valuation basis. Uh, but I personally would not invest in the company at this time, given its elevated debt load and heightened share count. It's certainly a name we will continue to follow closely, though, especially as hopefully that free cash flow continues to grow going forward here. And just a disclosure here: no one at Keystone owns the company.
Yeah, I mean, I think it's a pretty solid Canadian success
Mhm.
story, but yeah, I mean, the debt and the lack of free cash flow, really, like the multiple, even on a forward-looking basis, is high. With there's not a lot of organic growth in the business, really. You didn't see
Like there
any
was
breakout, really.
there was like decent in the last quarter, but like as I've looked at it in the past, a lot of the times like they
Historically,
haven't
there
even
has not
broken it
been.
out.
Yeah.
You know, I would say exactly. Most of the growth is from acquisitions. Exactly.
Yeah, and it's stellar growth from acquisitions, but you saw the share count moving higher and producing meaningful actual EPS is not there right now. And on an adjusted basis, it looks decent, but you
Mhm.
have to basically keep making acquisitions, so you're fighting against diluting or adding more debt. And it's if it was far cheaper, maybe there would be a case to be made here, but
Mhm.
I mean, we find companies that trade at lower valuations with more organic growth. And again, that's what we always say. This is better than like 80% of companies on the TSX, or maybe 90%. But we're looking for the top 1 or 2%, really. And does this fit that criteria? Probably not at this point. Certainly not a terrible company.
No. And like,
No.
just to compare it to, like there was another company again in like the fall of 2023 we recommended, which was like a healthcare, SaaS kind of
Yeah,
play. And they were trading it, significantly lower. Like I think it was like
we
10
brought them
times.
below 10 times free cash flow with net cash, not net debt,
Exactly.
and organic growth of like 15% plus. So
Exactly.
that's what we put them against. Now, they're not in the same business
No.
exactly, but they are in healthcare. They're servicing healthcare. And yeah, and that's what we were able to buy. It's a great example of, ranking companies against each
Yeah.
other in the overall market, and what is your opportunity cost for putting your money in this company versus another company. Yeah, and then that's what we were able to do at that time. And as an aside, I do remember Jack Nathan. We got
Mhm.
questions on that company as the stock surged, above $1.50. I think it's
Yeah.
gone to 2 cents now, or
Yeah.
2.5 cents, right? And we said this makes no sense on
Mhm.
several podcasts, and the business didn't. There wasn't a profit there. There wasn't what we look for in a business. And it's not I told you so, but it's just look at the stock price over the past several years. And Jack
Yeah.
Nathan looks like it's not going to be around
Yeah.
fairly soon. So
Yeah.
yeah.
Exactly.